We are going to be talking about investing in individual stocks today. I tend to go more of the real estate alternative investing side. I'm growing up these days and understanding that everyone wants to invest in their own things and everybody has a little bit different asset allocation mix. So I've brought on an expert today, Daniel Jiwani, who wrote the book, which you guys should go pick up on Amazon today, Pick Stocks That Go Up. So this is his second book. His first book was widely successful. I think, what was the title for that one again?
Yeah, it's Buffett's two-step stock market strategy.
We wanted to have a conversation on more of a systematic approach of picking stocks, if that's what you so choose. But maybe that first book you wrote with the Warren Buffett methodology, maybe tell us the story behind that book, because that's what really put you on the map. That's how I found you initially.
Yeah, sure. So when I was 16 years old, I had made my first stock investment. I invested in a company called General Electric. I put about $5,000 into the company. And within a few weeks, the stock fell like 60, 70%. And I basically lost well over half of my money. And what that loss taught me is that I really needed a system in order to pick stocks. So I started to study everything that Warren Buffett has ever said, read every book that has been written about him, watch all of his Berkshire Hathaway annual meetings. And one of the core ideas that I really came across was the idea of discounted cash flow. The idea that when you buy any financial asset, whether it's a piece of real estate, a franchise, or a stock or a business, the way you buy it is by asking yourself, how much money should I be willing to pay for this business given how much cash flow it will generate in the future? And that idea completely changed my life. It ultimately translated into the two-step strategy I talk in my book: buy a wonderful company, and two, buy it at a wonderful price using discounted cash flow. And that's how the book came to be. I knew that a lot of everyday investors specifically didn't know the importance of DCF or discounted cash flow when making investment decisions. And I wanted to make sure that everyone in the investment community understood that.
So we'll go into kind of that investment, that rubric that you were talking about, but you make a point in the book that stocks go down over the long term. Can you explain more of that? Does that something to do with the S&P being super weighted in guys like Nvidia?
No, that's exactly right. There's a common notion that over the long term, the S&P 500 itself goes up, and that's 100% true. That goes up by 8 to 12% per year over the long term. But when you take a look at the individual stocks within the index, that over the long term, a majority of the stocks don't go up. There was a really interesting statistic in my book, Pick Stocks That Go Up, that says that over half of stocks have underperformed treasury bills over the past century. So over the past 100 years-ish, most stocks have underperformed T-bills, which is really embarrassing. But the reason the index itself goes up year after year is because of exactly what you're saying. A small minority of stocks, Nvidia, Google, Tesla, Apple, they go up huge. They drive all the market returns. They have such astronomical returns that they bring the overall index up, even though the vast majority of companies over the long term don't perform well within the S&P 500. So in a sense, most companies are bound to fail within the S&P 500 over the very long term. And it's really the small minority of stocks and businesses that thrive over the long term. The takeaway for any investor who's investing in stocks, businesses, or whatever is that you really need to be in the minority of financial assets that perform the very best. Now, I know most your audience specifically is focused on real estate, and I don't have specific data on the real estate markets for this. But what I would imagine is that if this holds true in real estate, the takeaway would be is that you really want to invest in the highest quality investment opportunities within the real estate market because those are the ones that are going to perform the best. And you have to be very picky almost with the types of investments that you pursue.
I think this maybe sounds duh, but we'll break this down a little bit further. Something came to mind where I think like on social media, I saw this infographic. It was like a virtual infographic where the animation of all like the top 10 or so companies that were in the top S&P from way back in the day, 1900s, and how these companies just died off in the last 50 to 100 years. And the new top forerunners, the Magnificent Seven, they weren't even around back then. But I think that illustrates exactly what you're talking about. So before I think we start to break down what are exactly you're looking for, can you talk a little bit about like avoiding the losers? What to look for that first before we start to identify like what do the winners look like?
Yeah, so there's something that Howard Marks taught me. I learned from a speech that he gave, and is that you don't want to try to pick winners, you want to avoid the losers. And what he meant by that is this concept called a winner's game and a loser's game. A winner's game is something like a pro tennis match. The way you win is by placing the best shot so perfect that the other person can't return it. That's a winner's game. A loser's game in tennis is the opposite. It's like an amateur tennis match. The way you win isn't by placing the fanciest shot or hitting the ball the hardest. That's how you get miss and mess up. The way you win in an amateur's tennis match is by just hitting the ball just over the net so that you can play another hit or another round of tennis. And investing is exactly the same way. You don't win in investing by just hitting the hardest shot or placing the ball perfectly like a pro tennis match. You win by pursuing the same strategy as an amateur tennis match. You just need to get the ball over the net. You just need to make sure your investment doesn't screw up so you can continue investing for another year. So the key with investing is just to avoid losers, try not to make mistakes, and that's how you get risk. It's by making sure that you always prioritize risk management over returns. I know that there was this one investor, I'll tell you this quick story that illustrates this. There was an investor one time who was recommending me to invest in GoPro back in the day. At the time, GoPro had just IPO, the stock was booming. It was one of the hottest stocks in the market. I think it was up double digits almost every few days, it felt like. And the investor who recommended me to invest in it invested in it. His philosophy was GoPro's an amazing company. Yes, it had risks, but all the returns that I could possibly gain from GoPro are much oversee the risk potential of the company. But on the other hand, I personally took a different approach. I said, wait, there's risks with this company. Customers might not like the product as much as the GoPro's advertising it as. So there's a lot of real risks with the company. And although there's a lot of opportunity for the company to perform very well, it's more important to avoid these sorts of risks before we even consider returns. So I decided not to invest in it. And that turned out to be one of the best investment decisions I've ever made because now GoPro is basically borderline bankrupt if it's still around.
Yeah, it makes a lot of sense. But what if you take a point of view of some unsophisticated investors are the ones that never pull the trigger on anything? And when you really look at their portfolio, they don't have much because they took this approach of always seeing, identifying some type of risk and have it being the brakes to do anything and even to learn. But how would you take that into account?
I think, in my personal opinion, the investors who are being patient to find the right investment opportunity are really taking the right approach with investing. There's a really famous investor by the name of Nick Sleep, if you may have heard of him before. There's over 1 decade period of his career, he had read the annual reports of over 7,000 companies. Out of those 7,000 companies, he chose to only make major investments in three of them: Berkshire Hathaway, Amazon, and Costco it was. And because of that sort of concentration he had, the willingness he had to say no to lots of good opportunities to focus on the three that were really perfect for him, he was able to achieve about 20-ish, 21% returns per year for a little over a decade, which puts him on the levels of Warren Buffett. So I think those investors who are being patient, waiting for the right pitch, as Warren Buffett would say, are taking the right approach in the stock market. Of course, you do need a balance, never swinging the bat and eventually swinging. But I think it's a perfectly rational approach to wait for the right pitch to hit.
It's not investment advice, but this is just what I'm testing out personally these days is always want to be very selective and we say no to a vast majority of the deals, but at the same time, I want to still be active and doing something every quarter so I can achieve this balance, this never picking up the bat and swinging it and achieve this dollar cost averaging effect. That's what was in my head. But I think with stock investing, you also have the liberty of it's very common to have your money not doing anything and just being liquid.
Yeah, just to go off of what you're saying, one thing that I tell people is that Jeff Bezos, he started Amazon in the early 2000s, shortly before the dot-com bubble. Then it was only maybe 5, 6 years later that he started Blue Origin. And then it was maybe a couple more years later before he started some other side hustle. The reason I say that is that in real life, people don't start businesses every year or every quarter. they start a new side venture or side business every 5 years or so, maybe 8 years. And I like to take this a similar approach in the stock market. I don't like to invest in a new business every quarter or even every year. I like to invest in one good business every 2 years on average. Warren Buffett had, if you look back at Warren Buffett's track record specifically, he had made one major investment decision around once every 2 years. In fact, the top 20 of his investments basically accounted for all of his returns. And Charlie Munger's famous for saying that if he hadn't had the top 20 investments that he made around a 40-year period, you wouldn't have Berkshire Hathaway. So the point I'm trying to make is that he really didn't, he only made one major investment roughly every 2 years, one that was meaningful enough to move the needle. So you really don't need to make a big investment often in order to achieve Warren Buffett-like returns.
Yeah. And while we're on the topic, what would you say for somebody who has a few $1 million of investable assets? At one time, Jim Cramer, I don't know if he's made this famous, but he talks about going, you've got your money that you can play around with. So, whether that's 100 grand out of your 3 million or a million out of your 3 million, you break up in 5 or 6 chunks, right? Obviously, this is not investment advice, but for somebody in that network work range that wants to play around with this stuff, what would be your framework, or how many chips would you put into one? Or maybe you have five, or maybe you have 20 of these things at one time.
You bring up a really good point. And I think, like a lot of things in life, the answer is it depends. If you feel like you know a lot about investing, you know what you're doing, you're very picky about the types of investments you're making, and you are prioritizing risk management over everything else, then feel free to. What I would personally do, now this is not investment advice, but what I personally would do is run a concentrated portfolio like Warren Buffett, like Nick Sleep, buy one stock every couple of years. But if you're someone, even an accredited investor, who's perhaps more concerned about risk, concerned about losing money, maybe they don't know how to invest as much as don't know as much as they should about how to invest, or they still want to explore and learn how to invest, but want to get exposed to the stock market, then feel free to have more chips as you want. Feel free to diversify because Warren Buffett says is that diversification is a protection against ignorance. If you are not as smart as investing as Warren Buffett, feel free to diversify and don't follow his lack of diversification in his portfolio because you're not like him.
Yeah. And also to throw another data point in there that I think also follows your logic, angel investors. The thing about most angel investors that I appreciate is most of them are humble enough to know that they are on the ignorant side.
Yes, yeah.
And a lot of times they're investing more for the fame and glory of picking a winner. If you lose the money, you don't really need it. You're not gonna miss your meal. But I think in that circumstance, you see definitely that diversification, right? People
Yes,
jumping in,
definitely.
throwing in 10 grand here, 25 grand here, much more than maybe a quarterly occurrence, some even a couple times a month. I think that would definitely follow that same logic we were saying.
No, exactly. With angel investing, there's a lot of uncertainty about the future. There's a lot of risk. Unlike investing in like a blue chip company like Apple, you know all the risks, you know what you're getting into, you know you're owning a world-class company. With angel investing, you oftentimes don't know what you're getting yourself into. Even if you do a lot of due diligence, you don't know whether it's going to be the next unicorn or not. So what you're saying makes perfect sense. Angel investors do need to diversify quite a bit.
And normally, a good angel investor will never get involved unless the total addressable market is huge and there's potential
Exactly.
for many multiples, which is a very different type of investing. But to your earlier point about the S&P 500, that's what that freaking thing is all about. But yeah, let's get into this four-step investment strategy. Kind of people understand at least part of the steps that you talk about in your new book.
Yeah, so I have a very simple investment strategy that's based off the two-step strategy I initially created. The four-step strategy is first, find a wonderful company. Second, buy it at a wonderful price. Third, maximize upside. And fourth, manage. In theory, if you do all four of those things perfectly, you're going to have a portfolio that outperforms the market.
Like what rings in my head when you say that is go into a company that has been performing and has some type of major product or products that have a definitive advantage. Buy at the right price, so maybe you're buying on dips, and then have some stop losses in there was what came to mind. Let's dig in deeper.
Yeah, so in order to find a good company, the most important thing is to really buy a company that's so good that no one else can compete against it. Warren Buffett, not many people know this, but Warren Buffett is really famous for making several investments within 15 minutes of research. For example, he once got a call from the CEO of Larson Jewel. This was maybe late 90s, early 2000s. And it was basically the CEO wanted to sell his picture frame company to Warren Buffett. He had a 15-minute phone call with the CEO. He concluded that was a good business, that it was one that he wanted to make. A few days later, he went over to the headquarters of Larson Jewel, finalized the paperwork, had a final conversation with the CEO, and that was done. But within basically the first 15 minutes, 90% of the transaction was complete in Warren Buffett's mind. He knew it was the right investment. And the way he knew that it was a good investment was because he really concluded that it was so good that no one else can compete against it, no matter which company entered the market, no matter what happened in the industry, no matter what happened in the economy. His conclusion was that no one could displace it from its leading position. And he used the same framework when he invested in Mars, for example, around the '08 financial crisis. He had asked himself, if I had $1 billion and I was a competitor, could I knock off Mars? And he concluded that's not going to happen. So he bought the company very quickly.
So two words come to mind, a disruptor and a monopoly. Would you say it checks the box on both of those then?
I would say that he is known for investing in companies that are almost like monopolies. Apple obviously is not a monopoly, but his brand is so strong that it could be considered akin to one. Mars Wrigley is obviously not a monopoly, but it almost has monopolistic power in the market given how strong it is. So I wouldn't say monopoly is the right word. The key thing that he's really looking for is just himself, and this is what I call the $1 billion test, but really asking himself, if I was a competitor and had $1 billion or $10 billion, could I overthrow the company that I'm thinking about investing in? And if the answer is no way, no matter if the competitors had an extra billion, 2 billion, or whatever, they can't overthrow the company I'm investing in, then that's the company, then I want to invest in that company. And the Warren Buffett term for that is moat. You want to invest in a company with a moat.
Yeah, and this is where we look at a bunch of private equity or existing like software companies. They talk about moat all the time in terms of products and features, more importantly. But I think that's where sometimes that's a much weaker moat. Still a moat, but much weaker.
Now, the true test if a company has a moat is just asking yourself, it's really three different questions that you can ask yourself. The first one is the one I've been saying, if I had $1 billion, could I knock off this company? The second way to decide if a company has a moat is by following, is this company so good that no one else can compete against it?
With all the resources at your
Yeah,
disposal.
exactly. And the third test to see if a company has a moat is by asking yourself, does this company do something valuable for customers? Is this company rare? And is this company difficult to imitate? Valuable, straightforward. Does the company add a lot of value to customers relative to the competition? The second one is rare. Is this business a rare kind of business? In other words, Amazon is a one of a kind business. There's no business like it. So it's a rare business. Mobile is not a rare business. There's so many companies just like ExxonMobil, BP, etc. And then the third one is difficult to imitate. Is it easy for a competitor to copy exactly what I do? No one can really copy Amazon's business because as the economies of scale, the brand and everything going forward, the management team. But for a company like ExxonMobil or BP, it's very easy to replicate its business model and many people have, so it wouldn't pass the moat test.
Yeah, they have been just surviving with hand-to-hand combat. I know that industry a lot better these days. Them being able to partner with smaller operators to diversify their risk. They can't just rest on their laurels, for sure.
Exactly.
Okay, so that's a good company. Let's dive in. I don't want to give away the entire book, but what's the second point here to go into?
Yeah, and I don't mind giving away the entire book. The more I help readers, or the more I help your audience, the better it is for you and everyone listening to this. So we can give away the whole book if you want. But the second one is buy the company at a wonderful price. Here, the key is one, the discounted cash flow analysis I was talking about earlier. Asking yourself, is this company producing a lot of cash flow or free cash flow relative to what I'm paying for it in terms of its enterprise value or market capitalization?
So in real estate, we have the cap rate, right?
Exactly. Same thing, but for stocks, free cash flow yield.
Right. So this is different than the earnings per share metric.
Earnings per share is different than free cash flow. Earnings per share tracks basically how much money the company makes in earnings. But that isn't hard cash. There's a lot of elements like depreciation, amortization, a lot of different things that distort hard cash flow from how much a company reports in earnings. What we really want to focus on is free cash flow, which truly represents how much cash came into the business and profit in a year.
Yeah, so profitability, not just revenue, right?
Both earnings and free cash flow are measures of profit, but free cash flows focus on tracking how much hard cash comes into the business, whereas earnings is more of an accounting metric that doesn't really represent how much cash flow is coming into the business. It's more normalized.
Would you be able to give a real life company where their earning per share looks all right in comparison to competitors, but they really stand out, or maybe are really bad on the other metric?
No, there's a lot of examples. I know that you have heard of World, everyone in your audience has probably heard of WorldCom, that it was a big accounting scandal that went up back in the day. And one of the things that's really interesting about that specific scandal is that its earnings per share looked really good on the surface. Every year, earnings was growing, earnings and revenue were solid. But when you took a look at cash flow, you actually would see that its cash flow was negative every single year. But when you took at cash flow, you saw that there was a big problem. I believe they're reporting negative cash flow, declining cash flow in some cases. So what that would have told you is that something is wrong with this company. This company is not reporting a cash profit, even though it's reporting real earnings. Now, in that particular case, it was due to an accounting scandal and them not being honest with the way they were recording their earnings. But that even happens a lot of the time with just companies that are obeying the accounting rules and not cooking the books. I talk about in my book Netflix, for example. I don't remember the exact numbers off of the top of my head, but they, in certain years in their past, they've reported for example, these are hypothetical ballpark numbers, but maybe $5 billion in earnings, but only made $3 billion in cash flow. They were following all the accounting rules legally and like they should have, but just due to the way the accounting rules are set up, that's just the way they reported. And it turns out that the $3 billion free cash flow figure is a much more accurate representation of how much money they made that year.
So in your opinion, earning per share should be thrown out the window then, or does it have some purpose?
It has some purpose, but for the purpose of deciding how much money I should pay for this company should almost be ignored. There's a quote by Warren Buffett where he basically says that book value per share, PE ratios, and something else have nothing to do with valuation except to the extent they tell you about the amount and timing of cash flows. What he's getting at with that quote is that earnings per share itself doesn't matter. What really matters is how much cash flow will the business make, when it's going to make it, and how much it's going to make.
So what was that third of the fourth metric?
The third step is to maximize upside potential. Here, really, the key is to get in an industry that's growing, that's having consistent growth year over year. There's a really interesting statistic I came across, and I think it was Coca-Cola stock price from like 1970-ish to the present, or something like that. And what you basically saw is that over the time period of that study, a span of many decades, Coca-Cola stock price had grown about 60 times. But when you took a look at its market share over that period, its market share was flat at about 41.9%, give or take a percent. And that begs the question, how did Coca-Cola stock price increase so much despite the fact that its positioning relative to the competition did not improve, despite the fact that its market share did not grow at all? And what happened is that the soft drink industry as a whole just grew a lot. Margins improved in the soft drink industry. Per capita consumption of soft drink, I think, doubled and just grew tremendously. And the overall global population grew a lot as well. So all those industry drivers had contributed to Coca-Cola and even Pepsi experiencing huge increases in their stock price, despite the fact that their relative to positioning hadn't really changed that much. And what that taught me is that industry growth over the long term really matters. And if you think about it, that's true for virtually every public company. Virtually all the major public companies, especially the ones in the S&P 500, have very stable market shares. They're not changing from 10% to 20% market share over the next 5 years just because they're in very stable industries, just generally speaking across the S&P 500.
International too, right? So there's nowhere else to grow from that standpoint.
Exactly, yeah. They're just mature businesses almost. And they're so what I'm getting at is that those types of companies can't really grow by taking market share away from the competition, unlike a small VC-backed company. What's really a long-term growth driver for all the major S&P 500 companies is just the industry growing naturally. So it's really important that you are in the right industry.
This is really resonating with the angel investors mindset, which I don't know if they have four rules. They might only have two. And if they had two, this would be one of them, that the total addressable market, the upside potential needs to be there. Guys won't get involved in things unless there's a possibility of 20x or 50x or what. This is a kind of a crude,
Mhm.
ridiculous analogy since I got to watch my daughter on the baby monitor right this hour. But the analogy is if I could throw a baby in my living room versus my bedroom, the baby would obviously go higher in the living room because the ceiling is higher. The peak, the total adjustable height is higher. Would I ever do that? Hell no, that's stupid. Just like these companies that you see coming out angel investment world, that's probably going to be a loser. That's going to be a loser. He's got to pivot. We know that's going to be coming. But the point is, at least for this one pillar, is that upside potential is there. It also reminds me of NBA players. If you look at your lottery picks, very rarely do you see anybody under 6'7". They just don't have that upside. But I think that's maybe a good transition into the fourth one because I think definitely it is something that the angel
The
investor.
last rule, manage risk. The angel investors don't have it, but there's a couple of rules of thumb I would say here that I have, which we've touched on earlier for managing risk. One is to focus on avoiding losers rather than picking winners. In other words, focus on risk management over trying to get big returns. The second one I would say is just pick one stock every couple of years. Automatically, your risk goes down by making fewer higher quality bets than making many mediocre bets. So buy one stock every couple of years. There's this not so famous investor, but this regular investor that Charlie Munger, I believe, known, who was just this old woman, had a net worth of about 300,000-ish dollars or so in the bank in her times currency, which is really old currency. And she just put her money in three high quality companies, General Electric, Dow Chemical, and DuPont, held it for the rest of her life. And given those were really good companies back in the day, her net worth grew to like $1.5 million in her times currency, which is like $15 million today. That was a good risk management strategy, just concentrating all your money in three high quality companies, three concentrated quality companies, as we were talking about earlier, and just doing nothing. I think a couple other things on the risk management point is that another thing to do is focus on a qualitative margin of safety over a quantitative one. Warren Buffett is known, and Ben Graham, his mentor, was known for popularizing the idea of a quantitative margin of safety. If you think a stock is worth $10, pay $5 for it. You want to leave that room for error. What I think is more important these days is not so much having a quantitative margin of safety like that, but having a qualitative margin of safety. So that's all about being 110% certain that you are getting into a quality company, one that's immune to all sorts of risks.
Yeah,
There's even a line by Warren Buffett that's not famous at all. And I don't know why it's not famous at all, but he basically says that times have changed. These back in the day, what was important is a quantitative margin of safety or the Ben Graham margin of safety. Nowadays, my investing style has shifted toward having a qualitative margin of safety.
yeah, and I'm glad you put it that way because for people who don't know what they're looking at, which is probably everybody looking at all these companies from the outside, you're like, if I can get a bargain on something, 20% discount, 30% discount sounds good. But I guess echoing what you're saying here, try not to go down that road of just trying to get a good deal.
Exactly. Focus on quality over price first. Quality is much more important than getting the company at the right price.
You've mentioned that all invest major firms like the Big Four, like the Fidelity, your BlackRock, Goldman Sachs, use industry growth as a proxy for industry attractiveness. Maybe you can explain that a little bit more and how is it that maybe they've gone wrong with this?
Yeah, so earlier we were talking about how saying industry growth is super important, getting the right industry is super good. And to a certain extent, that is true. You can't have a lot of upside with companies in the S&P 500 unless the industry itself is growing. But in terms of industry attractiveness, determining whether a company is in a good industry, growth really isn't the best proxy for that. The example I'll give is really the automobile industry. Back in the early 1900s when the automobile first came out, the industry was growing tremendously. Almost every few years it was doubling, growing by 100%. Every decade it was growing by like 10 times. And it was completely revolutionizing the whole world. It was replacing horses. It was changing the way people transport from one place to another. So it was an incredibly fast-growing industry. It went from zero in the early 1900s to now being worth billions and billions of dollars, the point I'm trying to make. But despite the fact that it had grown a lot, it was an incredibly unattractive industry to invest in. Out of the hundreds of automobile companies that have been started over the past century, virtually all of them have gone bankrupt. The only ones that haven't gone bankrupt are like Tesla and one other one. And even the ones that are still around, like General Motors, Chrysler, and etc., they've gone bankrupt at one point in their history and had a rebound. So virtually all automobile companies have gone bankrupt. If you take a look at a lot of studies on the stock price performance of automobile companies, that a lot of them have not performed very well over many periods of history. So their stock prices haven't done well despite the fact that the industry itself has transformed America. The point I'm trying to make is even just because an industry is growing, just because an industry has the potential and will transform America, that doesn't necessarily mean that the companies within the industry itself will perform well. The true proxy for figuring out whether the companies within a particular industry will perform well or whether they'll end up like the automobile companies is focusing on a metric called economic profits. Economic profits basically measures the shareholder value that an industry generates for society. If you want to figure out how much economic profits a particular industry generates, there's a lot of studies online that try to estimate this and calculate this. But for the purposes of investing, the easiest way to know if an industry generates positive economic profits is by just focusing on return on invested capital of the industry. Generally speaking, industries that generate strong economic profits will tend to have return on invested capital that's above average 10, 12, 15, 20%. By contrast, industries that produce economic loss will earn a low return on invested capital, 5, 6, 7, 8, 9%. And the first thing I would do, I would say, if I were an investor deciding whether to invest in a particular company, would be to Google what is the return on invested capital of ABC industry that this company is in. If companies in general within the industry are earning a high return on invested capital, I would definitely consider it as a potential investment opportunity.
You said you don't believe in buying stocks that are going up, and yet at the same time you say invest in good companies. Now, inherently, we all know past performance is no indicator of future success. But is that
Mhm.
kind of the reasoning why you say don't bet on the winners, the late winners, I guess, the ones that are going up recently?
I think the reason I say that you shouldn't buy companies because their stock price is going up is because of a mindset that you need to have when investing. Because I'm still reading your book, which by the way, I recommend all your audience to read. It's a good book. But when you buy a piece of real estate, I would imagine that what's going through your mind is asking yourself, how much rental income will this property earn compared to how much I'm paying for it? And if this property is going to earn a lot of rental income relative to what I'm paying for it, it's a good investment. In the same way in the stock market, you want to have that exact same mindset. You want to ask yourself how much cash flow is this business producing relative to how much I'm paying for it. The mindset that's specifically dangerous in the stock market and can also be dangerous in real estate is starting to get in the mindset of asking yourself, okay, this stock trades at $20 per share. How much can I sell for it next year? $30 or $40? That's called flipping businesses or flipping stocks. You don't want to do that. And what would be a lot of people, not everyone, but what a lot of people say is speculative in real estate is saying, okay, this property is $100,000. What can I flip it for $130,000 next year? That's generally considered speculative by a lot of people in the real estate community. And that's how Dave Ramsey, the famous real estate investor, went bankrupt in his early years. And you don't want to bring that mindset in the stock market. That's why I say you don't want to buy a stock because you think its stock price is going to go up. That's the flipping mindset. You want to have a cash flow mindset instead.
Yeah, because in the stock world, you don't have any tying to the outcome. You're not doing any value add yourself. Your destiny is out of your control.
Exactly. And there's obviously differences between real estate and stocks, but that's especially true in stocks. Stocks are more volatile. Anything can happen in the market. A stock price could go down 50% tomorrow for no apparent reason. So there can be big disconnects between the stock price and how much it's really worth. And you don't have control over that. So when you buy a stock, what you're really making a bet on is what are other people's opinions of the stock going to be in 1 year? Because that's really what drives stock prices at the end of the day. And at the end of the day, you don't know what other people's opinions are going to be in 1 year. You don't know what news articles are going to be present about your stock. You don't know whether other people are going to be bullish or bearish. No one knows. No one can predict that. So if you're buying a stock just because you think it's going to go up, you got to be really careful in all honesty because it's a gamble at the end of the day.
But an educated gamble, right? Just like playing poker. Certain hands have a higher propensity to win. You just don't know what the other opponent has in their cards or what's going to happen from a macroeconomic standpoint.
But when you're dealing with your life savings, you probably don't want to take a poker like gamble.
I don't know. I don't play poker, but I would imagine people, if the total pot's $100 and they have 50% of the total pot, do poker players like break up their 50 chips into 10 bets in their head? What would you advocate as like a starting point or a range, right? Like, because where this also, to me, I always think I won't be here at some point and my kids are going to have free reign on all this money. Maybe I should write something in my trust where you cannot have more concentrated holdings more than 5%, right? Like 20 chips or whatever. But
Yeah.
what's your take on that whole predicament?
If the goal is really, if let me put myself in your shoes for a second. By the time you pass, you're gonna have a whole ton of money. You have a successful podcast, a book that's growing in sale, a real estate portfolio that's growing, and you want to make sure that your kids really don't mess up their lives. Your goal is just to make sure they do well for themselves. In that case, I would say why not just invest in something basic like the S&P 500? Your goal is not to try to make your kids super more wealthy, but just to make sure they keep the money they have, it continues to grow reasonably, and they don't screw up. Just invest in the S&P 500. I think that's exactly what Warren Buffett had done with it or plans to do with his own kids, the money that's going to his kids. What they plan
Yeah.
to do is basically just give the S&P 500 to their kids because there's no reason to take on that added risk when you're dealing with your kids' money.
Yeah, but I guess in this circumstance, what you talk about in your book is we're trying to grow our money, right? And we're not just going to sit on our butts and have it just grow at that lower rate. But how should people think about when they make trades? Should it be, it certainly shouldn't be half or a quarter of their whole pot, but what's a good starting point for people to think?
Yeah,
If I had 100 grand, should I be making 5K trades or 10K trades or maybe less or more? What's a good starting point that people start off with this stuff?
if I were starting fresh today and I wanted to learn about investing, I would do something either 20 bets, 5K each for a 100K portfolio, or 10 by 10, 10 bets of 10,000 each. I think that's
And
a reasonable balance between diversification and being concentrated for someone who's just getting their feet wet in the market.
yeah, obviously not an investment advice guy, but I think that's pretty reasonable too, I would say. If you're a little bit less confident, maybe more self-aware, you go less, or you break it up more. But if you're a little bit more risk tolerant, you go more.
Exactly.
And then some of those holdings you're holding for maybe 4, 5, 10 years too in that. So it's not like it's a transitory portfolio too when you're doing that.
You're 100% right.
I think this is maybe a good stopping point for people to go pick up the book. How can people learn more about what you teach out there?
There's two main avenues right now. The first is the books, Buffett's two-step stock market strategy, and the new one, Pick Stocks That Go Up. And the second avenue is if you go on my website, there's a button that says investment principles. If you go there, it compiles almost 40, 50 different investment principles from my book, Pick Stocks That Go Up. So if you just want to get a snapshot of virtually every single principle that's described in that book, you can go there and get a quick snapshot of the lessons that you would learn.
Yeah, and we live in the era of AI. You guys could probably go to the YouTube and download the transcript, which is in one click on this, and then take what Daniel's saying, go get his lead magnet there, and maybe build yourself a little custom chat GPT. You're silly if you don't. in a way. And it's not investment advice, but I think what AI is great is it's an iterative process. You can run what you thought and then what the knowledge base gives you feedback on it. And I think that's a great way to learn because that's all it is. You got to learn by doing here.
Exactly.
But yeah, anything we miss for the folks out there?
No, the last thing I'll say is obviously check out your book as well. I was reading your book before we were recording this podcast, and it's a really good book. I love the concept of the wealth elevator, and check it out. I would recommend it to everyone.
Yeah, no, thanks for that, Daniel. Appreciate it. But yeah, thanks for you guys for coming out. I think where a lot of this gets lost is getting around other people who are actually doing this. If you haven't yet joined our group, you've got to do that and have a call with me to be able to come to our in-person events. And I think that's where you can get to know people and uncover these types of conversations on people's investment portfolios look all very different and even in their stock portfolio, maybe some people are doing things like this to some extent. It's something that typically you don't really talk about with your family and friends out there because you could pick a loser and we don't like to talk about our negatives there. I say that jokingly, of course. But yeah, thanks for Daniel for jumping on. Again, the book is called Pick Stocks That Go Up, and we'll see you guys next time. Bye.